The next pattern we're going to look at is consolidation patterns. Consolidation patterns include pennants, triangles, wedges. They also include flags. This, what you see on the screen, is what a flag basically looks like in an idealized scenario. A bull flag is a consolidation pattern during a dominant uptrend. The flag entails the price rebounding roughly off two short-term parallel trend lines before then breaking out in the direction of the dominant trend. And the direction of the dominant trend on this diagram is upwards. So let's look at this in a bit more detail and see an example. Here's our pattern: up, consolidating, and then up again. Let's have a look and see how this looks. Well, let's have a look at the first flag that I can see, which immediately comes to mind. Here it is in the middle of April. Let's have a look at another one at the end of April, and let's see if there's another one at the beginning of May. These are all pretty easy to see. The opposite of a bull flag is, you've guessed it, a bear flag, where the trend goes downwards. A bear flag is a consolidation pattern during a dominant downtrend. The flag entails the price rebounding off two short-term parallel trend lines before breaking out in the direction of the dominant trend, which in this case is downwards. So let's have a look at an example here. Here we see the diagram, and let's have a look at the real-life example. This was an absolute beauty, by the way, which many people on my blogs will have seen. So, in the middle of January we get this beautiful bear flag on the way down, but then we get another one, and then we get an even better one at the beginning of February. Look at that! Anyone with no experience could probably have seen that. I'll just show it to you again. You see the flagpole on the way down, and then you see the consolidation pattern rising up. I can tell you this, it doesn't get any better than that. And not only that, but it is so easy to trade. The key is being able to find them. Being able to find them only takes a bit of practice, and once you've got it for life. The key then will be how to find them on a regular basis, and that's where I come in to help you. Let's now look at the next pattern, pennants and triangles. Now, pennants and triangles are basically a variation of a flag. They are typically a consolidation chart pattern, so let's have a look at one here. To me, it's arguable whether it's a flag or a pennant. Here, you could argue it both ways, and really it doesn't matter because we're going to play it in the same way anyway. So there's one you can see. There's actually quite a few here, but there's another one at the end of May. Very easy to see. In fact, there was another one at the end of April as well. Our next pattern is a bullish pattern, and it's called the bowl. Here's what a bowl looks like, and basically when the stock breaks out above the first lip of the cup, and I've drawn that little dotted line there, when it breaks out through there, that is seen to be a bullish sign. So let's have a look at this in a real example. And there we have a bowl, and here we have a wider bowl. We can have bowls within bowls within bowls, and those bowls can be very shallow, and those bowls can be very wide. Those bowls can be very short term, over a few days, or those bowls can be very long term, over a few months. But here's the thing, we can do much better than just a bowl. We can have a bowl, and we can also add to the bowl a flag, and when we do that, we create a cup and handle. Two bullish patterns for the price of one, and what we get is a very strong pattern. Here's the bowl, and there's the handle. So it's a cup and handle, it's two patterns in one effectively. And when that breaks out, then we have a very strong signal, but we play it largely as a flag, and I'll go into detail about that a bit later. You might recognize this is actually the same chart as before. We could have seen these as bowls, or we could have seen them as cups and handles. I like to see them as cups and handles. And as you can see, up it went. The next pattern we have to be aware of is support and resistance. Now I just want to emphasize that this chart is disgusting. This is a horrible chart. I don't want you to see anything good in this chart whatsoever in terms of how we trade flags. However, there are very clear areas of support and resistance here. Let me explain to you what I mean. even though they're over a long period of time. This pink line here depicts an area of resistance. We could have drawn it more precisely, but you can clearly see the line is hit 3 times in a period of only 4 months. We also have an area of support, which is the floor. Here we had 3 or 4 times where the stock rebounded off at roughly $66 or just below $66. Where this gets slightly interesting is because what will happen is support, if it's broken, will then become resistance. In this example, the stock has broken down through support, and that broken support line will now become an area of resistance. Similarly, if the resistance line had been broken on the way up, so the stock had broken up through the resistance line, then that resistance line would now become an area of support. So, why is this important for us? Well, there is basic support and resistance within the flag or within the consolidation pattern itself. Look at what's happening on the screen now. We've got the upward thrusting movement followed by the consolidation. The consolidation forms a line of support and a line of resistance. When the resistance is broken, then we might want to get ready to trade, or even have an order that allows us to be in the market once that resistance line is broken. We'll get into more detail on that very shortly, but for now, let's move on to another one.